Okay, so we're going to talk about gold today. If you're subscribed, you'll know that I'm generally very bullish on gold and have been for some time. But as gold's price continues to rise, our thinking does have to adapt to the new valuation. As the value of any investment goes up, at a certain point, we have to ask ourselves the question, are we approaching the limit for how high it could go? Yes, gold has performed very well for us over the course of 2020, but is it too late to buy gold today? Or instead, could gold price continue increasing further? I mean, when you think of why people have been buying gold over the past few months, I think it's fair to say that the same reasons are still around today and in fact could get even worse. So let's get straight into it and try to answer the important question. Could gold continue rising further? First off, I'm not a financial advisor, I'm just a regular guy researching investments to really get my own head around things, and then I'm just sharing this research with you. If you do appreciate the time and effort that goes into these videos, please make sure to smash the like button as it helps with the YouTube algorithm. So let's get into it, and to understand why gold could continue rising further in price, we have to briefly talk about why people buy gold in the first place. After all, gold doesn't produce anything, and it doesn't give you a return. Essentially, gold is just a rock or a precious metal which sits there. But you see, what gold offers is the ability to hedge against inflation. In other words, if you think the high inflation is coming, you might buy gold to hedge your bets. And gold is also described as a safe haven. When people are fearful of a downturn in the economy or a crash in the stock market, well, people often turn to safe havens such as gold. So in other words, gold usually does its best when you fear that the next decade might not be quite as bright as the previous, whether that's because of high inflation, a slowdown in the economy, or a crash in the stock market. So let's think about a few factors that have caused gold price to rise so much over the course of 2020. And then let's ask ourselves the question, do we see these factors continuing, or do we think they'll begin tapering off soon? That could be an indication of where the price could be headed over the next 12 to 24 months, or even longer. First up, we have low interest rates. As noted here, interest rates in many countries are at or below zero, which is a key ingredient for any bull market in precious metals. So basically, central banks will raise or lower interest rates based on what's going on in their economy. When things aren't going so good, they'll lower interest rates in an attempt to give the economy a boost. Well, as we know, gold tends to perform well in an environment when things aren't going quite so well. As a result, a low interest rate can actually be seen as an indication that gold could shine. But more importantly than that, much more importantly than that, when interest rates are low, it can reduce the competition for gold. What do I mean by that? Well, when times aren't as positive in the economy or the stock market, some investors might turn to bonds instead of gold as a safe way of investing their money. However, when interest rates are this low, and they really are at historic lows, it also reduces the return the bonds give you each year. So imagine this for a second. Someone says to you they think the stock market might be about to crash. So maybe you should take a portion of your money and invest it somewhere safer. Well, you could invest it into gold, which tends to perform well in the bad times, but it's also pretty volatile. It can go up and down to quite extreme price levels. Or you could invest your money into bonds, and you'll be guaranteed a 3% return on your investment each and every year. There's a good chance that gold could actually outperform bonds. But if we're mostly worried about just protecting our money first and foremost, many of us might consider taking that 3% guaranteed return each year. Now, though, what if you had to choose between gold and bonds, except you couldn't get that guaranteed 3% return anymore? Instead, you might get a minus 0.25% return. Yep, you heard that right, and I still sometimes struggle to believe it myself, but many central banks globally are actually offering negative interest rates, which literally means you would have to pay them for the pleasure of lending them money. Now, would you rather invest into gold, which can be volatile but also tends to perform well in these times, or would you rather hold a bond which guarantees you lose money? You see, because interest rates are so low, even compared to most crashes throughout history, it could turn some investors away from bonds when they're looking for safety and instead turn them towards gold. As we look towards the future, the Fed has said that they will do whatever it takes to support the economy. They've also said that they won't drop rates to negative numbers, but I think we can expect interest rates to remain extremely low, and the vast majority of analysts don't see this changing anytime soon. So this really is a factor which could continue forwards. Now, I know what you're thinking. If I'm looking for safety, I'll hold my money in cash. Nothing is safer than cash. So, because of low interest rates, bonds aren't as competitive with gold as they might otherwise be when you're looking for safety. But what about holding good old cash? Well, in order to stimulate their economies, central banks globally are printing vast quantities of cash. The idea is that they can provide that money to the entities and businesses that need it most, and that will help the economy during these tough times. The downside of this, however, is that it increases the risk of inflation. To think about it simply, if we add more dollars into existence, well, there's a good chance that each one of those individual dollars is going to become less valuable. But to be fair, inflation is a lot more complicated than that. Really, it's more based on demand. So when times are good, people are going out and spending lots of their money. The economy tends to become heated up and inflation begins to rise. Conversely, when times are bad, people don't spend as much, the economy begins to suffer, and we can actually head towards deflation. If the Federal Reserve didn't step in and start printing money, there's a good chance that serious deflation could have started, and that's really not good for the economy. So the Fed is currently printing a lot of money, and that should be positive for the economy. It's also going to push up the inflation rate, which, to be fair, probably isn't a bad thing if it means avoiding deflation. But the problem comes when the Fed is faced with a choice of when to stop printing so much money. If they stop too soon, the economy may fall into a backward trend, which they've worked so hard to pull everyone out of. If they stop too late, the economy may be okay, but the currency will be pushed to a point of high inflation. And with economics, it's really not as simple as just saying, let's stop at the right time. So you have to ask yourself, if the Fed is going to lean more towards one way than the other, stopping too soon or stopping too late, which is it going to be? For me personally, I think the Fed wants to avoid the economy sliding backwards at all costs, which means they'll probably lean towards stopping too late out of the two directions. And I'm not alone in thinking this either. Investment bank Nomura recently said, we expect the US dollar to follow a path of reduced dominance and weaken over the long term. And recently we've seen that the dollar index has slid to a 2-year low. In fact, if we take a look at the US dollar index on a chart showing its performance in 2020 so far, we can see that the trend has been negative, especially over the past couple of months. And let's not forget that this index is a comparison of the dollar to 6 other fiat currencies, many of which have also been printed in large sums over the past few months. As a result of this, when investors are looking for safety, holding dollars, just like with bonds, doesn't look so appealing. And when you consider the real estate prices have continued to rise in most areas, in spite of the macroeconomic situation we're in, you could argue that all of this means less competition for gold. Now, to be clear, I don't think a smart investor completely overlooks cash, bonds, or real estate as part of an overall portfolio. I'm not saying completely get rid of all of them, and I'm not saying that that makes sense. I actually think it's a good idea to hold a minimum of 12 months expenses in cash, a portion in bonds, and a portion in real estate too. But what I am saying is that these investments don't look particularly good compared to other times. So when investors are thinking of how to make their investments safe, while still trying to get a decent return on their money, they may look to other investments such as gold. In fact, Frank Holmes, the CEO of US Global, recently outlined his theory on Kitco News for why gold is headed to $4,000 based on the quantity of money being printed. Let's hand it over to him.
Well, I've said on your program before that this is going to cost the US government approximately $10 trillion in fiscal and monetary policy to get the economy back. And so I think that number you're seeing back in 2008-9, after Lehman Brothers went bankrupt, you saw the balance sheet expand from 1 to 3 trillion. So I think it's got to hit this overall $10 trillion. And so what does that project? In the next 3 years, if you look back, if it repeats itself from 2008, 2009 to 2011, that 3 year run from '09 was a gold went from a 750 to 800 range up to 1900. So if we forecast that, because we have the same expansion of the balance sheet of the Fed, then it would project, if cycles are exactly the same, gold could go to $4,000. So I think it's rational, and I think also very different from this cycle to the previous cycle. Prior to 2008-9, we went on an incredible run from 2001 up to that date. And that run was where the G20 finance ministers and government agencies around the world were all pro-trade, pro-growth. Ever since the crisis of '09, it's all been about synchronized taxation and regulation. And now it's synchronized money printing, monetary fiscal stimulus that we've never seen. If you go back to when Alan Greenspan was the head of the Fed, he left the Fed with about 6%. The balance sheet was 6% of our GDP. Today, with Powell, it's 33%. And this is how much money that Powell has to throw at this because of the coronavirus and the synchronized shutdown of the world. This is unprecedented. So I think hard assets trade higher.
Later in that interview, he outlined his thoughts on central banks playing in the stock market and the impact this could have on gold's price.
But we got to remember what's happened that's very different today is that you have these central banks that, like Switzerland, that go and raise money. They don't go and buy bullion like before they used to. They buy stocks. They buy Apple because the dividend yield is higher than what they have to go and pay. So they can create this funny money with this negative real rates return. They're going buying Nestle's. They're buying quality blue chip stocks around the world. They own 15% of their own stock market. The same thing has happened in Japan and other countries. So I think there's a real difference of government and government agencies playing a bigger role in the capital markets, which has always historically been a bullish sign for gold.
On top of the factors we've already covered, I would say that there is more uncertainty in the world now than just about any time in recent history. We don't know if there will be second, third or fourth waves. We don't know if we'll have a vaccine in the next year or if it will take years. We really don't know what the new normal will even look like for now. And on top of all of that, the election coming up at the end of the year adds even more uncertainty for businesses. Well, we know that gold tends to perform well in uncertain times. So again, this could be bullish for gold. But the one thing that we do know is don't fight the Fed. And this is really an interesting point, and it's one of the reasons I'm bullish on gold, because we're kind of seeing a weird pattern emerge. As the Fed pumps more money into the economy, the dollar weakens, and just about all investments are growing at the same time. As I discussed in a recent video, the S&P 500 and commodities index were each up more than 25% since the end of March, while the US aggregate bond index added more than 3% in that span. So we often see individual markets perform well, but during that time, another market might struggle. Maybe stocks will perform well, but commodities will struggle, or vice versa. But it's very rare to see stocks, bonds, and commodities all simultaneously increase. And analysts are putting it down to the fact that money, which is being pumped into the stock market, is spilling over into other markets such as gold. So the term "don't fight the Fed" is generally applied to the stock market, but the Fed has actually provided so much stimulus this time that their actions are causing other markets to rise too. In other words, if they keep printing money, there's a good chance the gold will continue rising as money continues to spill over from the stock market and other investments. So as crazy as it may sound, investing into gold over the past few months has essentially been betting with the Fed. Now, I think there's actually a downside to this too. You see, if buying gold has become kind of like betting with the Fed because of all that money spilling over, well, what happens when the law of diminishing returns kick in and the Fed's interventions begin to have less and less effect? If this could lead to a crash in the stock market, and we've seen this growing correlation between gold and the stock market, I would say that a crash in the stock market is now more likely to be matched with a crash in gold. Certainly in the short term at least. But I would say the gold status as a safe haven could mean that it might crash less compared to the stock market when the day eventually comes. And that's why I really like gold, even at the current price. You see, I think gold has a large upside potential for all of the factors we've mentioned, because interest rates are low, because money printing isn't nearing an end, because money is spilling over from the stock market, and because the competition is less at the moment than it has been historically. And I think gold might have less downside potential than something like the stock market because of its status as a safe haven. That's not to say that gold can't and won't crash. It can, just as any investment can. That's not to say that gold won't have dips and pullbacks along the way, because it certainly will have dips and pullbacks. But I think if we just look at the macroeconomic situation, it's almost a perfect description for a time when gold should perform better than other investments. And most analysts, and myself included, don't see the macroeconomic situation changing anytime soon, which means the situation really is still set up for gold to continue outperforming other investments. I'm keen to hear your thoughts. Let me know what you think about gold. Do you agree with me, or do you think something completely different? I'm always happy to have an open debate. If you've enjoyed this video, check out this one up here, and of course, just thank you for watching.